should you compare P/E ratios across diverse industries? Imagine trying to compare apples and oranges and expecting the same results. That's similar to comparing price-to-earnings ratios across different industries. It might seem straightforward, but it can lead you astray. The P/E ratio shows how much investors are willing to pay for each dollar of a company's earnings. You get it by dividing the current stock price by earnings per share. But industries have very different characteristics that influence these ratios. For example, technology companies often have higher P/E ratios because investors expect rapid growth. On the other hand, utility companies tend to have lower P/E ratios since they grow slowly and have stable earnings. Risk levels also play a big part. Sectors with higher operational or regulatory risks usually have lower P/E ratios because earnings are less predictable. Stable industries with consistent earnings often have lower ratios as well. Business models and how companies finance themselves matter too. Companies with high debt levels or asset-heavy structures can have different earnings patterns, impacting their P/E ratios. So, comparing a tech company's P/E ratio directly with a utility company's ratio can be misleading. It's like comparing a sprinter to a marathon runner. They're built for different things. When analyzing stocks for market analysis and strategic trading, it's best to look at the P/E ratios within the same industry. This gives you a fairer comparison and helps you see if a stock is overvalued or undervalued relative to its peers. Using forward P/E ratios, which are based on projected earnings, can help you understand expected growth. But always interpret these numbers in the context of industry norms. Combining P/E ratios with other metrics like the PEG ratio, which compares price to earnings to growth, or debt levels and cash flow, gives a clearer picture. For options trading, understanding industry-specific valuation norms helps you anticipate how stocks might move. If a company's P/E is high compared to its industry, it might be due for a correction or increased volatility. Conversely, a low P/E could signal a bargain or a warning sign. In the end, P/E ratios are most useful when you compare companies within the same sector. Cross-industry comparisons can distort your view and lead to poor decisions. Always keep the industry context in mind to make smarter trades and better investment choices.